Hello and welcome to Simplicity in Stocks. India's specialty chemical industry has quietly evolved from being an input supplier to a critical enabler of global manufacturing. Export demand for these chemicals have risen, domestic consumption has increased, and global supply chains are looking at India as an alternative sourcing base. None of this is breaking news anymore, and the stock market has long priced this in. But what is interesting today are the smaller specialty chemical businesses that are coming out of a painful 12 to 18-month period. Many small cap chemical stocks fell significantly between 2023 and 2025, but their fundamentals remained intact. Many of these companies now have better operating leverage, cleaner balance sheets, broader product portfolios. In this video, we will look at 5 small cap specialty chemical companies that can be good additions to your watch list. Please note that this video is for information purposes only. It's not a stock recommendation and should not be treated as such. There is no opinion or view on any stock covered herein. Aether Industries. Aether Industries stands out in the specialty chemicals pack because it has been able to grow when most of its peers have struggled with inventory issues. In FY25, the company reported consolidated revenue of Rs 8.4 billion, up more than 40% year-on-year, while net profit rose to 1.6 billion. Aether manufactures advanced intermediaries and high-value niche chemicals used in pharmaceuticals, agrochemicals, coatings, electronics, and material science. It's not exposed to the low-margin commodity cycles to the same extent as many other companies are. The nature of its product basket allows for some pricing power and good export potential. The stock price has corrected from its peak levels, but this has not changed the business. Aether has been commissioning capacity in phases and has retained healthy capital allocation discipline. The business is not debt heavy, and the management reinvests internally generated cash. In 2026, capacity utilization will be crucial. If exports recover, then Aether's fixed asset base can deliver operating leverage, which can in turn drive profit growth. But risks remain as far as exports are concerned. Anupam Rasayan. Anupam Rasayan has been through a complete sentiment cycle. The stock fell sharply in 2023 as margins compressed. It then gradually recovered as investors spotted early signs of demand improvement. The business is attractive because it operates in the middle of multiple high-value sectors. Pharma, agrochemicals, polymers, dyes and pigments are all part of its customer mix, which gives the company diversification. Coming to its financials, its sales and net profits have grown at a CAGRs of 10% and 2% over the last 3 years. In the September 2025 quarter, its quarterly revenue crossed Rs 7.3 billion with a net profit of Rs 570 million. The company has been signing multi-year export-linked contracts with global players in pharma and agro intermediaries. The company has product depth, customer quality, and manufacturing capability. What it has struggled with in the past 2 years was a combination of input cost pressures and delayed customer orders. Now, these problems may not disappear soon, but over time, as demand normalizes, contract execution could improve and margins may expand. And that will be what investors will have to watch out for in 2026. Balaji Amines. Balaji Amines is a more mature business than many of its peers. It's one of India's largest producers of amines and amine-based derivatives. Its sales and net profit have grown at a CAGR of 8% and 10% over the past 5 years. FY25 was a difficult year for the company as revenue declined from Rs 16.4 billion to Rs 14 billion. The net profit fell from Rs 2.1 billion to 1.6 billion. The big question for investors is if this is a cyclical or structural slowdown. Balaji Amines has gone through similar cycles before. Volatility in costs and demands are inherent to the amine industry. Historically, the company has bounced back when utilization moved back up and margins recovered. What will matter in 2026 is demand in the core end user markets. If the pharmaceutical and agrochemical sectors stabilize globally, then demand for amines could recover. That would be a big positive for the company. Finotex Chemical. Finotex Chemical has transitioned from being purely a textile chemical supplier to a diversified specialty chemical player catering to water treatment, construction, coatings, leather and adhesives. This diversification matters because the textile sector has been through a painful demand cycle. Exposure to other industrial and consumer sectors helps to stabilize revenue. The company's recent quarterly revenue came in at rupees 1.5 billion with a profit of over 260 million rupees. In the past 5 years, its sales and net profit have grown at CAGRs of 22% and 50% respectively. The stock has fallen about 30% from its peak because the textile segment remains weak and the company is meaningfully exposed to it. Margins have held up reasonably well, but growth has not met market expectations. In 2026, if Finotex can continue reducing dependency on textiles and also scale up water treatment, performance chemicals and industrial applications, the business could become less cyclical and more stable. Finotex has strong tailwinds if demand across construction chemicals and industrial applications improves. Rosari Biotech. Rosari Biotech is an interesting example of how diversification can either shield or dilute returns depending on macro conditions. The company has a presence across textiles, animal health, nutrition, cleaning chemicals and industrial chemicals. This business model reduces dependence on a single sector, but the last 2 years were not easy for the company. Textiles and fashion demand were weak globally, which impacted sales. The company's margins also compressed as input costs remain elevated. The stock has fallen almost 33% from its highs. Coming to its financials, its sales and net profit have grown at a CAGR of 28% and 16% respectively in the last 5 years. The company is expanding its distribution network for chemicals in the textile, agriculture, home and personal care, oil and gas and pharma sectors. The company has also set up 20,000 MTPA capacity, which was commissioned in September 2025, to produce specialty chemicals including the raw materials used by other group companies. The company also has robust in-house R&D facilities. The small cap specialty chemical space has been through a difficult period, but the underlying industry structure has not deteriorated. Many stocks have corrected sharply from their highs, and because of that, market expectations are moderate. This gives businesses room to surprise on the upside. Investors should focus on 3 things: volume growth visibility, margin trajectory, and balance sheet strength. Specialty chemical stocks can be rewarding, but they are not momentum trades. They are process heavy, multi-quarter execution stories that demand patience from investors. If investors are willing to think beyond the next quarter's earnings, then this sector may offer favorable risk-reward equations. It's necessary for investors to analyze the company's fundamentals like financial performance, corporate governance practices, and growth prospects before considering any investment. Happy investing!